Good afternoon, everybody. Thanks so much for joining us for our live Thursday webinar. I'm Leah Kolich, an investment counselor here at RealWealth. And today we are talking about homeowners insurance. I'm joined today by Seth Mark from Inrig, National Real Estate Insurance Group. Hey, Seth.
Well, hello, Leah.
Thanks so much for joining us, guys. Inrig is a new national insurance sponsor with RealWealth. We have partnered with them because they cover a very broad range of property types, investment types, and also they're nationwide. So they can help our investors who are building diversified portfolios across numerous different states and create some ease by maybe having one go-to insurance company across multiple states. Insurance is one of these topics that I feel like doesn't become really interesting to people until they've got a property under contract and they're trying to make their bottom line, monthly holding cost numbers work. And I think the tendency for a lot of investors is to try to find the cheapest policy they can get. I guess I feel like I can confidently say this because I am one of these people, but we're a little stingy when it comes to our bottom line, right? And insurance is one of those things where sometimes you get what you pay for. But it can be really hard to understand what the different coverages include and what we as real estate investors should be asking, that maybe different questions than we'd be asking if we were insuring a primary residence for ourselves. So we've asked Seth to come on today and give us a little class on what services they offer and the insurance coverage that they offer, and a little bit of insight to how they might be able to help you insure your portfolio. Great. So the strategies that we're going to talk about today might not be appropriate for everybody. Other options that we don't discuss today might be more suitable for your specific circumstance. So as always, you want to consult with your own accountant, tax advisors, attorneys, your support group to discuss your specific situation. Past performance is no guarantee of future results. Real estate purchases are, of course, always subject to investment risks, including the possible loss of amounts invested. So we've made every effort to bring you guys accurate and current information today, but know that there's a possibility of errors and updates down the line. So definitely plan on connecting with Inrig directly to get any updates to some of this content as this information becomes maybe a little dated into the future. All right, Seth, I will hand it over to you. I'm here to learn just like everybody else today. So I'm going to go off screen and let you take the stage. But I want to remind all of our participants that are on today, you can send in your questions and interact with us. We're going to have a dedicated Q&A session at the end. So Seth, I will disappear behind the scenes and be monitoring the questions and join you back at the end. All right?
Fantastic. So a little bit about me. I've been in the insurance for quite some time, for about 12 years. Started out on the retail side, have experience on the MGA wholesale side, which is not really relevant for this group, but been writing insurance in several different markets for different capacities for quite a long time. And I am the national speaker and educator for National Real Estate Insurance Group. So let's just hop right in. So who is NREIG? NREIG is a national independent insurance agency, and we administer an insurance program that caters specifically to the residential real estate investor. And so we're experts in what we do. We're not going to be able to talk about, your homeowners for your personal lines, life insurance, things of that nature, but we really have a good handle on what it means to properly insure your investments. And we accommodate investment portfolios from either one unit all the way up to 20 units at any one location and in any stage of occupancy. And we'll talk a little bit more about that as we go through. So a little bit redundant here, but who are we? We are that National Real Estate Insurance Agency. The first bullet point there is from 1 to 20 units. Even with multiple ownership entities, we can still combine that to a single schedule. And that creates efficiencies for you from billing, keeping things straight, servicing, making changes, things of that nature. Like I said before, we do all phases of occupancy as well. So we do vacant dwellings, we do occupied, and we'll do renovation rehab as well. One of the unique things that make us different than the traditional way of doing insurance is we don't have to cancel and rewrite in between changes of occupancy. And so if you have a location that's occupied today, but it goes vacant, and now it's time to, hey, look, we need to go in and rehab it a little bit before we bring the next one in. Well, in the traditional insurance space, you would cancel your policy, get a builder's risk policy. Once the course of construction's done, then you would go back to either a vacant or an occupied. Ours are not like that. All of those occupancy statuses are endorsed to a single form. And so there is no cancel rewrite. We can simultaneously go in between occupancy phases and make it very simple for you. And really that just creates a lot of headache on your end when you have to cancel and rewrite a policy, because you're out of pocket for another down payment waiting on a return premium, and we're just not going to subject you to that. Our program is a monthly reporter, and what that does is that offers more convenience for you, and I'll give you a couple of instances here. But what it means is it's a pay-as-you-go, and so there doesn't have to be a long-term commitment. It's really great when you're doing rehab on a house and you might be even selling it or even holding it, because in the traditional insurance world, you would buy that builder's risk. They would have a 12-month fully earned premium, which means you have to pay for the whole year whether you use it or not. Ours, being a monthly reporter, you're not going to have to do that. You're going to only pay for what you need, and then we'll change the occupancy status as needed. No coinsurance when insuring above $60 a square foot. And there's another slide here in a moment that I'll talk a little bit more about that. But we just made a decision a while back that we are not going to offer coverage to an insured where you're going to be subject to a coinsurance penalty at the time of loss. It's just an egregious event that you have to go through, and we don't want to do that. So we're going to offer no coinsurance penalties as long as we're insuring at $60 a square foot or above. We will also do liability only insurance. So this is relevant for, let's say you just have a piece of vacant land that you're going to build on, or you made a purchase and another lot comes with it, so you need to insure that. That way, if the neighborhood kid's riding across it and has a bike wreck and breaks their wrist, there's coverage there for that. But it's also relevant that if you have rental dwellings and they're paid for, and you're at a place where you're like, hey, look, I don't necessarily need to insure the structure, but you always need liability. Liability is going to be the cornerstone on which all other coverages are built. And then coverage for any type of property. I want to go ahead and go to the next slide because it illustrates it a little bit better. So we do all different types of dwellings. So single family, multifamily, up to 20 units at any one location. And keep in mind, because we write this on a schedule, if you have one location or you have 1,000, we can put them all on the same account. Now, if you're doing renovation, so let's say you're purchasing that property that you're going to have to rehab before you put a tenant in it, or it might be a fix and flip opportunity. We do the renovation coverage under the builder's risk. We will also do new construction. So if it's ground up new construction, back to that, hey, I've got some vacant land, I want to develop that, we can help you with that as well. The vacant policy, it always comes up because sometimes you have somebody move out and you don't have somebody lined up, or there's something that's happened that has made it where you can't rent that for a period of time. The vacant policy is very relevant when we do that. We also do vacation rentals. So if any of you out there have long-term rental occupants, but then in certain areas you purchased locations where you can rent it out like an Airbnb or VRBO, we have coverage specifically for that. Condominiums as well. Condominiums are going to be a walls in, because condominiums are unique because the condominium association is responsible for the building itself, but the individual units are the responsibility of the owner. So we'll do those condos for you as well. Mobile and modular homes. So we are one of the few that still do this. We will do the mobile and modular homes. It's not necessarily that we really want a whole lot of that, but we want to be able to offer coverage to an investor that you might have a bunch of single family and a couple of multifamily, but you've got a really good opportunity in a specific location to purchase a mobile home that really fits with your strategy. That's something that we're going to be able to help you with as well. That liability we talked about earlier is the vacant land. So we will do just vacant land if that's something that you're needing done. And then if you're buying notes, and specifically non-performing notes, the unique thing about the about the real estate investment space is there's a lot of ways to make money in it. We try to incorporate as many different options in it so that we can cater to whatever you're doing and whatever strategy you are using. So the non-performing notes and also the lender-placed insurance. So lender-placed is really good if you're going to carry the note for somebody that's purchasing a property. And let's just say they don't carry insurance. and it lapses. You can then use our forced place lender product to meet that need. Now, let's talk about the types of coverage forms. So we offer a basic form and special form. There is one in the middle called broad form, but we don't utilize it. It's not really relevant for what we're doing. And basic form is all of your basic catastrophic perils. So fire, explosion, wind, smoke, vehicle, and aircraft. So if something runs into it. For those of you that live around a volcano, volcanic actions included as well, which I know is obscure. Sprinkler leakage. So if you have a multifamily that has a sprinkler system in it and you have a sprinkler leakage issue, it does cover that. And then vandalism and malicious mischief. It also covers riot and civil commotion. And so over the last 5 to 6 years, we've started to see, protests and things developing where we're having loss of property and property damage occur with that. So that is covered under under basic form for you. Now, the difference between basic and special is special, you get all of the coverages under basic with some additional. And there is a difference in the form as well. So basic is a named peril form, meaning that the carrier is going to list out exactly what is covered. And if it's not listed, it's not covered. So it's really simple. The special form is an open perils form, meaning it's covered unless they list that it is not. And so it puts the burden of proof on the carrier to prove that it's not covered. And it's just a different claims experience. But really where the rubber meets the road for you, the investor, is going to be the additional coverages that you get with special. And it adds, falling objects. So the meteor falls out of space or wheel falls off the plane. I know it's remote, but it is covered. Weight of snow, ice, and sleet. So if you have investment properties in an area where the climate's a little bit colder, and you do get a lot of frozen precipitation, this is a coverage that you will want to consider. Water damage is the next one, and this is the one I talk probably most about because it's not flood insurance. Flood is for rise of groundwater due to a lot of rain or whatever. So when a creek or river overflows its banks, that's going to be flood. Water damage is for when you have, let's say you have a pipe burst. It just happens, and it does happen whether it's a frozen pipe or not. Sometimes they just give way, and you've got 2,000 gallons of water in your dwelling now, and that causes havoc. So water damage is specifically for that. Now, we do see a higher prevalence of this in colder climates where pipes will freeze, they will burst. I'm not saying that it won't happen in like Florida or some of the southern states, because it absolutely can. But it is something to consider, whether you want to do basic or special form and kind of where you're at in your investment strategy and along the way. Collapse is also covered. Risk of direct physical loss. That's a nice obscure one there. But theft, everybody understands theft. So we will cover theft under the special form. So primarily what we see is, if somebody drives up and they cut the air conditioner compressor off the outside of the dwelling and they take it to the recycle plant, things of that nature. They steal your appliances, that's great to have. But keep in mind, the contents of your dwelling is the responsibility of the tenant, and that's what renter's insurance is for. So this is for your appliances, the heat and air, any kind of plumbing fixtures, things of that nature. And the big difference between these two is there's going to be a cost difference of 20 to 25%. Sometimes it's a little less than that, but generally it's never going to be over that 25% mark. So let's talk now about loss settlement methods. So what happens at the time of loss? So you've had something happen. Let's just say you've had a kitchen fire. Replacement cost and actual cash value are the two loss settlement methods, and we'll talk about the differences between them. So replacement cost allows you to recover your depreciation, where actual cash value doesn't. And we're going to run through a scenario real quick to kind of illustrate what the difference is. And both are relevant depending on what your need is and where you're at. There's questions that we'll ask you during the interview process to determine which is going to best fit your need. So actual cash value, let's say, if that structure burnt to the ground tomorrow, would you rebuild it in that location, or would you take the money and go invest in another property? Well, that might be an instance where actual cash value is going to be a better fit than the replacement cost. Now, the difference between the two, there again, is 20 to 25%, depending, on where it's at, the insured value, things of that nature. So let's do the actual cash value example, and then I'll talk about what replacement cost is to recover that depreciation. So we've had a kitchen fire. The loss estimate's $30,000, and that's pretty average for a kitchen fire. The adjuster is going to show up. They're going to, and whether you have replacement cost or you have actual cash value, they're going to depreciate the structure based upon how old it is and when the latest updates were in it. So that's determined by what they consider the active use is left in that. So how many years of use that you have, and they'll depreciate it X amount. So in this scenario, we're going to say, hey, look, they're going to depreciate it $12,000, and then you're going to have to take your deductible off that. So on an actual cash value, a $30,000 loss minus the $12,000 of depreciation minus your $5,000 deductible, it's going to end up netting about $13,000. Now, keep in mind, an actual cash value, you're not obligated to repair that. And so if you wanted to sell that as is, let somebody else come in and rehab it, take that over, then that would be perfectly fine. So let's take a step back to the last slide. In the instance that you had replacement cost, they would issue you the check minus depreciation minus your deductible. Once you complete the repairs, your contractors would submit back to the carrier, and you can recover that depreciation if you have replacement cost. Now, choosing the right deductible, let's go ahead and move forward. Choosing the right deductible, it really comes down to the specific investor. What your risk tolerances are. If you're a new investor, maybe a lower deductible is more important for you. It's going to cost the premium to be a little bit higher, but it's going to be less risk of out-of-pocket money in the time of loss. Whereas a seasoned investor that, if you have more locations, you might choose a higher deductible to keep the cost of your insurance down, because everybody knows we don't want to pay more than what we have to. So the coinsurance that I talked about earlier, so we want to avoid it at all costs. And I'm going to kind of back up to the scenario that we just talked about. So if you had insured at less than $60 a foot, which we're not going to do, but let's just say hypothetically you did, and the carrier now says, hey, look, you have to insure to 80% of replacement cost, or you're going to have a coinsurance penalty. What that is they take the difference to which you insured against replacement cost and give a value on that, and then they take that out of the settlement as well. That's why it's not a good experience to have, and at NREIG, we're just not going to offer anything that ever puts you in a situation where you're going to have to deal with the coinsurance penalty. So liability, when we were talking earlier, I talked about the cornerstone of insurance, which everything else is built on. And I speak with investors nationwide, and on occasion I have had people say, you know what, I don't need to carry liability. Liability is an absolute must. If you're going to cover anything, you need to have the liability, because liability, if you're ever drawn into suit because of a bodily injury or, God forbid, a wrongful death, those are scenarios that cause bankruptcy to investors. And so we're always going to say, make sure that you have enough liability. And we offer 3 different levels of liability: a 1 million with a 2 million general aggregate, a 1 million with a 5 million general aggregate, and a 2 million with a 5 million general aggregate. So let me explain what that really means, because I know I said it and it sounds nifty, but the per occurrence limit is the maximum amount that a carrier is going to pay out for any one event. So $1 million is the minimum that we sell here, because for single family, we monitor litigation nationwide. It's something that we stay on top of, and we're confident to say, hey, look, with a single family dwelling, $1 million is generally going to be sufficient for whatever you're going to run across. Now, the aggregate is the annual limit or the capacity. So you could have 2 $1 million losses if you had a 1 million with a 2 million aggregate limit, or if you had $500,000 losses, you could have up to 4 of those. So it basically it's the vessel of capacity that you could use within your policy term. Now, I talked about single family and $1 million being sufficient. Our liability is per location, so it's dedicated coverage. We have no shared limits, no shared aggregates. That's not how we're going to do it with the liability. So for every location, you're going to have dedicated liability limits of at least $1 million. Now let's talk about the multifamily units. So in multifamily, pardon me just a second. In multifamily, there's exposure there that so let's say we have a quadplex with 4 units and something happens. Well, we may have more than one party involved in that because there's more than one, family living there. And so we recommend that when you do have multifamily, that we increase that to the 2 million per occurrence, just because we don't want to dilute that if multiple parties are involved. And so there's several different options that we can talk about to determine what's going to be best for you when we talk through the scenario with you. So let's talk about our ancillary coverages. So we'll do the property, we'll do the liability, but we also have all of those other coverages that need to fill in the gaps based upon where you're investing and what type of dwelling you're investing in. So flood coverage. Flood is very straightforward. It is what it is. It's for riser groundwater, like I mentioned before. Earth movement. Earth movement is, our product is for earthquake and sinkhole, and it's available in every state except Alaska, Hawaii, California, Illinois, and Florida. Terrorism. Terrorism is something that we're going to include on every policy, and it's very inexpensive. It covers acts of terrorism, acts of sabotage, as well as evacuation expense if something does happen. And it's $1 per unit per month. So it's very, very affordable. Service line is another one that we're really excited about. So service line coverage is something that we just brought on in the last year, and it's coverage for all of those service lines that are underground in between the dwelling and the city easement. And so sewer, water, electric, data, or gas. And so let's say you have root infiltration into your sewer line, and now we have to replace that sewer line. It's not an inexpensive thing to have to do. And so we have 2 levels that you can purchase service line coverage. So one is $10,000 and the other is $15,000. And it's a very inexpensive add-on. It also does cover excavation as well as replacement of, so let's say we had to tear up a sidewalk or a driveway, to replace that as well is covered within the service line coverage. Now, equipment breakdown. This one is, I used to sell it a lot for like multifamily, where you have like unified systems. Let's say you have a boiler because it's up north. In the south, we're not going to have boilers, but we will have heat and air units. We will have, hot water tanks, things of that nature. It does not cover like normal wear and tear. But let's say you have a 3-year-old heat and air unit that you have a catastrophic failure on. Any damage to that unit and the structure as a result of that catastrophic failure is covered under equipment breakdown. So there again, it's just another thing to put in your arsenal to protect whatever assets you have. Property managers E&O, this is our newest one. And so for you guys that manage your own properties, what we've seen nationwide is an increase in tenant discrimination claims in court. And so if you're managing your own property, you don't have professional liability, which is what the errors and omissions is, you're not going to be covered for that. And you can be sued pretty much at any time for any reason for that. So it's one of those things to think about adding on, because tenant discrimination is covered under the property manager's E&O. And the tenant protector plan, my absolute favorite. So tenant protector plan, it's our version of renter's insurance, but it's not an HO4. It's not designed like that. It's designed really to protect you, the property owner. And what it does is it's a dual benefit product. So it gives benefit to your tenant, but it also gives benefit to you. And the first coverage is additional liability for tenant negligent acts. So when they catch your kitchen on fire, or when they leave the candle burning in the bathroom and now we have a fire there, or drapes, or any myriad of different things. It's $60,000 or $100,000 of additional liability for that. And what that does is it offers a safeguard or a hedge against turning that property claim in on your primary property policy, because we all know what happens when you turn in a claim to your next year's premium. It's going to go up. So if we can safeguard against that by putting it on a different policy that's not going to impact that, we might as well be looking at that. And you can purchase the tenant protector plan whether we insure the property and liability. It can be a standalone product. That's something you choose. Now, for the tenant, there's $10,000 worth of contents coverage. So you can say, hey, look, if you rent from us, we're going to provide the $10,000 worth of contents coverage with you. And most people just pass this cost back to their tenant. It's either $10 or $14 a month, depending on whether you want the 60 or 100,000 limit. And on the property, on the contents coverage, there is a $500 deductible. And there's a very good reason for that, because you want that tenant to have a little skin in the game so that they don't turn in fraudulent claims. One of the biggest things about the Tenant Protector Plan is it restores sewer and drain backup to your policy. On most program business, sewer and drain backup is a standard exclusion. And so when we talk about that, most people don't really think about it unless you've ever dealt with it. But if you've had, a tenant with they flushed something down the toilet that shouldn't have gone, and now we have standing water in our bathroom, there is a difference between water damage and sewer backup, because sewer backup is called a brownwater incident. We have now a biological component introduced into the dwelling, and it has to be cleaned up in a different way. So just really important that it acts as a buyback to restore that to your policy with us. And then lastly, it provides a skip rent benefit of up to $1,000. And so this is triggered in several different ways. So when I say up to $1,000, if you have an $800 a month lease, it's going to pay $800. If you have a $1,200 month lease, it's going to pay up to that $1,000. It's not going to extend above that. But it's triggered in a bunch of different ways. So let's say your rent's due on the 1st, it's late on the 5th, you haven't received it, it's now the 8th, and you're driving by and there's nobody there. They're gone. They've loaded up, they're off in the night. It does happen, unfortunately, and so that does trigger the skip rent. You can claim up to that $1,000. What is there for us to help pay if you have a note on it, or if you need to expedite a crew to get in there and get it cleaned up and re-rented, it's great for that. The other ways that it's triggered is if you have somebody that's deployed. That's not something within anybody's control, and so that does trigger the $1,000 benefit. And then lastly is the worst one. We have a tenant that passes away. So whether they pass away in a car wreck or they pass away in their lazy boy watching Wheel of Fortune, either way, you can then call upon the $1,000 of lost rent. So a couple of other coverages. We offer renters, it's the renter protection plan, it's renter's insurance. This is not something that we sell to you. This is something that you point your tenants to the nreg.com/renters for the renter's insurance, or the canine guard. So let's talk about the renter's insurance real quick. We were talking about the tenant protector plan. It does not give them general liability. It gives additional liability for tenant negligent acts. And so it is important for you to require them to have renter's insurance so that they have that liability component in there. Just in case, something happens and, we get called into court. The best thing about our product is that when they go online, there's a portion that says, name your property owner. When they put you on there, it lists you as additionally insured. And so if they do something, and they get called into court, well, you being the property owner, you're going to go with them. Well, if you're additionally insured on their policy, you can pull on their policy instead of using yours. And so it's just another good way to hedge against any loss or financial detriment to yourself. Now, the canine guard is our general liability policy per location has dog bite coverage of up to 50,000, and it does not have a breed restriction. But there are times when you're going to want to make sure that you have canine guard in play if you allow people to have dogs in the location. So this is just something else that they can go online. The same thing applies with the additional insured, where they're going to list you. But it is wise to make them have dog bite coverage, even if it's a small dog, because if you look at the statistics, smaller dogs, there's more dog bites turned in by, or dog bite claims turned in by small dogs than the actual big scary dogs that everybody's afraid of. So, but the canine guard, when I said that our liability for the premises liability has no breed restriction, this one is breed specific. And so this will add coverage on top of it so you don't have to pull on that on your policy. So what's next? If you need a quote, we would encourage you to go to this site right here. It's nreg.com/RWN. What that does is that allows us to track that back to the RealWealth team. And then that way, we're able to help you understand, what group you're with, things of that nature. So you got something, Leah? Question?
Excellent. Yeah, the questions are coming in, Seth. I think that was a really good overview. The first question that I want to ask is a clarifying question. Someone wants some clarification on what you meant by the $60 per square foot. What is that in reference to?
Okay. So when we're calculating what's called TIV, total insured value, let's say we have 1,000 square foot dwelling. We're going to want to insure that to at least $60,000. So that equates to $60 per square foot when you break that down. And so that's how we calculate things when we insure the value of a structure. Replacement cost, true replacement cost ranges anywhere from like 130 to 180, depending on where you're at. And that's, for something above builder's grade. And so we always take that into consideration when we're running the quote. We're going to visit with you to figure out what you want to insure. Now, I'm glad they brought this back up, because our system is a tiered system. So $60 a square foot to $79.99 is going to offer a actual cash value proposal and policy. Anything above $80 a square foot is going to provide a replacement cost policy. And you may be saying, hey, look, well, you just said true replacement cost is 130 to 180. Well, what we found, and the reason that we dropped our tier and we're the lowest in the industry here, is because investors are a little bit more savvy than the average person. And so they have those connections with the contractors that they always use. And so they may, these connections may allow them to repair or replace things on that structure a lot less expensive than the normal person. And so it gives you the option to lower that if you want to. So did that answer your question?
Yeah, I think so. Tell me this, is there incentive, is there financial savings for somebody who wants to move an entire portfolio under you guys? Maybe they currently work with 6 or 7 different insurance companies across their portfolio. Is there a financial benefit to like consolidating, or do insurance companies not usually like that?
Well, so the answer is yes, and it depends on the portfolio and where it's at, because we have 20 different carriers that we utilize nationwide, and it really depends on which carrier that I can get credits with on that. But the truth about the discount or the bundle is this, and if you really think about it, it just does make sense. If they're going to offer you a 15% discount for giving them 10 properties, they had that 15% leeway right out of the gate, and they're just not offering it because they want more. We're going to give you the best price that we can give you on the first go around. Now, if you have a schedule of, a large schedule, then yeah, there are some things that we can do to get that cost down. If it's a very large schedule, maybe we'll do, your own master policy, something like that. But those are things that we take on a case-by-case basis. So the answer is yes, but it's not always just cut and dry.
Okay, so you guys do offer master policies as well?
Yes. So everything we do is on a master policy basis. And there's a lot of things that are misunderstood about master policies because there's a lot of different ways to administer them. And one of the things that I get asked a lot is, well, a master policy, are you sharing risk? And there are people out there that do that. We do not. And so just because we have a master policy, it means we're lumping locations onto one policy, but they have dedicated coverage per location with no shared limits or no shared aggregate.
Okay. You mentioned that you work with 20 different carriers nationwide. Somebody asked that question, which carriers do you work with in different markets? I imagine it varies market to market even.
It really does, and it depends on the location. It depends on the property type, because a mobile home, I'm going to use a different carrier potentially than a 20-unit apartment complex. And so 70% of those are domestic carriers. The other 30% are through our Lloyd's of London contracts, because on the coastal stuff, the domestic carriers don't play as easy there, so we utilize our Lloyd's of London contracts. But every carrier that we do use is A-rated. And so you're not going to get an A- or B+ rated, and that's an AM Best score. What that means is the AM Best rates gives the carriers a rate based upon their financial security, meaning how much they have in reserve. What that equates to is the ability of the carrier to pay the claim. we're only going to do A-rated or more, because if something happens, you got to get paid.
Right. Okay, so how often should an investor kind of look at their current insurance policies and kind of run quotes again? And maybe is that a service that you guys do every year? Are you kind of re-looking at the policy and making sure that the investors are getting the best coverage and rates out there?
So we have something called the care process, and that's an annual review where we're going to go through the portfolio. We're going to look at the carriers. If we can move it to a carrier that maybe we just brought on that has a lower rate, we will do that. But as far as shopping it goes, a minimum of every 2 years, because things change in the insurance space very quickly. Just like we were talking about this before, Florida. We've seen it's been a whirlwind in Florida. There's a lot of carriers that are taking serious rate because they don't want to take on excess capacity. And so when that happens to you, it definitely is to your benefit to send the portfolio over to us. And you can just send it in, an Excel format, or we can do it over the phone. It doesn't really matter. But to answer your question, at least every 2 years.
Good. All right, let's get into some of these more specific ones. This is an interesting one. Is it required to notify the insurer when a property is temporarily vacant, thinking in between tenants, no rehab, just tenant leaves, and it's being shown to new prospective tenants?
No, that's a great question. So different carriers have different thresholds that they adhere to. But what we do is 60 days is the threshold. So if it's vacant for 60 days, I'm not going to worry about it. But on day 61, we do want to know, because we want to change it to a vacant policy. The reason that we want to do that is, so let's say it's been vacant 90 days and we didn't know that, and then it burns to the ground. The adjuster is going to come out and they're going to assess the damage, but they're also going to ask about, well, is everybody okay? Did anybody get hurt? And you don't want to say, well, it's been vacant for 30 days and we're at the 90-day mark, because that'll just complicate the process. So 60 days is our cutoff. I think that's fairly common within the industry. So as long as it's 60 days or less, you're good to go. But on day 61, please let us know.
All right. Okay, Seth, you and I talked about this before the call, and there's a couple questions here. So let's talk about it. A lot of our investors are acquiring property in Florida, and Florida is a tricky state for insurance. Maybe always this time of year when we're getting close to hurricane season. And I mentioned to you that we've had several people call recently, us investment counselors, to mention that they're either getting dropped from some of their insurance policies, or their premiums are going through the roof, or they're being told you got to put a new roof on the property or something. Yep. So let's talk about Florida. What are the challenges you see in Florida, and how do you guys handle that?
Okay, so you kind of hit the nail on the head. Let's give the back end. So there has been legislation recently about the roofs, and basically what was happening is there was companies that were out there that would go out and say, hey, look, we want to inspect your roof, and we'll turn in a claim for you if you have any damage. But then what that company does is they turn it in, and before we have a chance to respond in the industry, they're now taking us to court to max that policy, which is really, that's fraudulent. But the state of Florida didn't necessarily see it that way. And so a lot of carriers are now saying, hey, look, we need to make the decision of whether we're going to play in Florida or not. And what's happened is that, like you said, a lot of these carriers, they're not saying, well, we're going to pull out of Florida. But what they'll do is they'll raise their rate to the point where they're not going to be insuring properties because the rate's too high. On the other side, we see companies that are just saying, hey, look, we're out here, and they're pulling out of Florida in droves. Now, we are one of the few that are still there. The answer is yes, we will still write Florida. We look at it on a case-by-case basis, but a little bit of transparency about what happened to us during this process is when all these other carriers did this, there was a panic, and everybody's rushing to us. Well, we took on a lot more locations in a short amount of time, and so we're now renegotiating our capacity with our carriers to increase that so that we can continue to write Florida. We're not going to pull out of Florida. We currently write there, but it is going to be a case-by-case basis, and we're going to underwrite that a little bit stricter than we would, let's say, something in Ohio.
Yeah. How do you think your rates fare compared to other insurers that you hear of, other competitors? I mean to put you on the spot, but I'm just curious.
So we are very competitive on our rate. Um, 8 out of 10 times when I issue a proposal in Florida, they're buying it. So we know our
Okay.
rates are very, very competitive there. And keep in mind, it just depends on what you're wanting. And so if you want named windstorm, wind and hail, which I'm going to tell you, please always get it in Florida. But there are investors that say, hey, we don't want that. Well, that's a little bit easier to insure, especially this time of year, because you really hit it there. We're coming up to hurricane season, and this is the time where we've looked at the forecast for hurricanes, and the carriers are kind of holding their breath. So now's really kind of a difficult time.
Mhm.
But bottom line is, if you need insurance, send it over to us, and we will do our best to place
Okay, excellent. So here's another specific Florida question. This person says, Florida, I believe, requires insurance to provide catastrophic ground collapse coverage, not sinkhole. I guess, is this the case? And is this something that's included in the basic policy?
it. So it's not required, I can tell you that. And there's a difference between sinkhole and catastrophic ground collapse, and it comes down to the legalese and how they write that policy. And so we've been wrestling with it so that we can bring our earth movement, which will have sinkhole coverage or catastrophic ground collapse. But that's a little bit trickier of a subject. And so I do know that we write it there without it, so I know it's not required, but it's always going to be a tricky situation for Florida. There's just no way around it.
Yeah. Okay. I'm sticking on Florida, Seth. I'm sorry. We'll get off it.
No, it's fine. It's fine.
But the next question is, they noticed that in the ancillary coverages, hurricanes weren't mentioned. Is hurricane coverage not an option? Explain that.
Okay, so hurricane option is always included on our policy. So every policy that we issue, unless you do not want named windstorm coverage, and we can exclude it, but it's going to be included on all of our policies, no matter if you're in Texas coastal, along the Gulf Coast, Alabama, Mississippi, it's automatically included under the wind hail. So no, I did mention it because it's already built into the policy.
Okay. Okay, I lied. One more. Are you guys underwriting roofs over 15 years old in Florida, or do you require them to be under 15 year? These are,
No,
see, our people, some of them are hurting.
no. Well, and you know what? Absolutely understand that. The answer is
Yeah.
we are underwriting roofs over 15 years. Now, if we write the policy for a roof that's older than 15 years, the roof will be dealt with on an actual cash value basis if we have a loss. If it's 15 years or newer, we can apply the replacement cost to that. So the answer is yes, and no, we don't require any kind of wind mitigation report or anything like that.
Great. Okay, let me see here. A couple quick ones here. Do you offer umbrella insurance?
Okay, so we have a very specialized program. We have a sister company called Sandstone that we can do umbrella or excess liability. And I get asked about umbrella all the time, and it's one of the most misunderstood coverages out there because a lot of people say, hey, you need an umbrella. Well, we don't write it in the program because it's really specific, but we do have access to it. Keep in mind, an umbrella is a coverage that's going to cover multiple policies with underlying limits, whereas you could get excess liability to stack specifically on the liability per location and still get the same bang for the buck and not have to juke and jive around whether the carrier likes the underlying carriers that they're going to cover over in an umbrella. So the answer is yes, but it may not be the best thing for you depending on what your circumstances are, and we can talk about that.
Yeah. I always ask for a quote at different liability with extra liability coverage on the individual policy anyway, and usually it's not that much more to up it.
Yeah. Well, it's less expensive to go from the 1 million with a 2 million aggregate to the 2 million with a 5 million aggregate than it is to go buy $1 million of umbrella.
Right. Okay, do you guys offer any coverage for eviction losses? This was a popular question during COVID and our moratorium on evictions.
No, so unfortunately, no. We don't. Now, wrongful eviction, there is certain coverages under with the property manager's E&O, but it's pretty specific. And due to the pandemic and things that were, we've never experienced before, it's uncovered a lot of things in that specific arena that the insurance industry is still trying to catch up with.
Okay. What is an average claim amount, if you know it, for accidental injury on the premises in investment property? Is liability insurance coverage of $1 million sufficient, you think?
Yes. So on a single family dwelling, this is what we know, because we do, we pay attention to litigation and trends and things that are happening. So on a single family home, the reason that we only offer $1 million and above is because to guard against bodily injury or wrongful death. So I don't know specifically what the average is, but it's going to be 100,000 and less for bodily injury. Now, if it's serious bodily injury where, we now have paralysis or, it's life altering, it can go up from there. But generally specifically on single family, $1 million per occurrence is going to be what we recommend 100% of the time.
Okay, I'm not 100% certain about this question, but what about residential and commercial office space and industrial buildings in one package?
Mixed habitational. That's what we call that. And so we do. So keep in mind, I've got our sister company called Sandstone that we can help you with that. If it doesn't quite fit. Now we do have the ability to do light mixed habitational. So let's say it's a downtown area that's going through urban renewal and people are investing in it, and it's got retail on the bottom and it has 2 floors of apartments on top. As long as the commercial occupant is what we consider light commercial, so office space, retail space, something of that nature, there is a product that we have for that. But if it's, it's a bar or a tattoo shop or, a nightclub or something like that, that gets into something that you're going to need a different commercial product for.
Okay. I like this question because it's about usability of your platforms. What about investor portals? Do you have 20 different carrier portals or do we use one portal?
No, you will get one portal to access, because here's the thing. We utilized all these different carriers because we have to encompass the full spectrum of risk nationwide. It's not something that the investor is really ever going to have to tangle with or worry about. We'll manage that on the backside. You get a portal that gives you direct access to all of your documents, any requests that you need to have made, the way it gets right into the service department. So yes, we have a portal, and no, you're not going to have to worry about the 20 carriers.
Good. So in keeping with this theme, this person wants to know about the customer service experience. Can you describe your customer service team and maybe even how it looks? Because once you have a claim, you're usually dealing directly with the carrier, correct? And not necessarily your team?
So not necessarily. So we have some carriers that administer their own claims. And in that scenario, you would call in, we would report the claim to the carrier, they would contact you within 48 hours and get that process going. And so they're going to have somebody on the phone with you, figuring out what happened so they can schedule somebody to come out in a very short amount of time. We never like to prolong that. That's not a good customer experience. For the ones that don't administer their own claims, we use a company called McLaren's International. And one of the guys that I've known the longest in the industry, he actually administers those, and their service level is extremely high. So there is no reason to sit around and think, hey, am I going to get paid for this? When are they going to call us? We're going to be contacting you within the first 48 hours.
Great. All right. I'm assuming you guys work with international investors all the time, right? But you only insure property in the United States, correct?
That's correct. That's correct. There are a couple of things about that. Is they have to be funding the insurance from a domestic recognized bank. It could be if it's Chase Bank, but they got a branch, overseas, that's fine. But it has to be a domestic bank. That's really the only requirement we have for international investors.
Okay. Do you offer coverage for self-storage businesses?
Yes, we do. So that doesn't fall within the NREIG habitational investment side, but we have something called Storage Guard. So we do have a program specifically geared to if you're investing in storage facilities, yes, we can cover that.
Great. All right. Barclay really knows insurance here. He says, are your carriers considered surplus lines or AM best rating of lower than B plus V7? Because this is what my umbrella requires.
Okay. So every one of our carriers is excess and surplus, but don't tie excess and surplus to AM Best because it's two different things. AM Best is the financial rating of the carrier, and we're only going to use A-rated or better. The reason that we like the excess and surplus is because they allow us to manuscript our forms, and it allows us to be more flexible with coverages that we apply. When you go to an admitted carrier, you have to file it with the state, and it takes forever to make changes, things of that nature. And that's why we just prefer the E&S space.
Great. We can't stump you, Seth.
Well,
You've done this before.
A couple of times.
Do all your friends call you when they have their own claims with insurance to make sure they're not missing something?
None of my friends know I do insurance. I'm not going to deal with it. No, I mean, oddly enough, yes, I do get people, and even people that aren't current clients of mine that I wrote, 10 years ago that I just had a good rapport with, and they call and say, hey, what do I do? Well, yeah. I'm always going to answer the phone. Whether you're a client of mine or not and you need help, that's what we're here for.
Oh, that's awesome. Okay, let me see here. Doesn't TPP, which I think was the tenant protection plan, also cover eviction in addition to skip? Maybe I missed it when Seth said it. I have TPP on all of my properties and have used it 3 times for evictions, but now I'm worried that that benefit has been taken away since I didn't hear it mentioned.
So, no, there is a scenario where you can use it for that. And I did mention that in one of the triggers because that's just not one of the ones that we normally advertise. But yeah, no, you're not going to lose the benefit.
Great. And that tenant protection plan, I think, might be worth doing. I had a recent experience with a tenant accident that caused a significant claim. And it was all covered. Great. They put it back together. But it has, it rears its head down the road when you're getting policies. And I didn't realize, I guess, at the time, the implication that could have. So I think in hindsight, purchasing that additional TPP. And what did you say is the average cost of adding that on to a policy?
So for $60,000 in coverage, it's $10 plus taxes and fees. So it really comes out to about $12 a month. If you want to do $100,000 of that liability for the tenant negligent acts, it's $14. So really, you're going to pay about $16 a month for it.
Okay. So another question I have. Yeah, I had an insurance guy tell me that now since you've had a major claim on a property, that you should lead with that now in every conversation you have with an insurance provider. And I'm wondering your take on that. I mean, what are owners obligated, I guess, to disclose right off the bat? What can you guys see from your end? Like how close hold should we be about past circumstances?
Well, so transparency is an absolute necessity when dealing with insurance because it can cause you problems if you don't disclose that. The carrier could say, oh, hey, look, you didn't disclose this to us, and you never, ever want to give them an opportunity to do that. Whether I would lead with it depends on what kind of loss it is. Because if it makes you look, like, hey, look, you weren't paying attention and it was something that was an avoidable loss,
right?
Don't lead with that one. Now, we're always going to ask you, have you had losses in the last 5 years? Our platform, here's the difference, because I come from a traditional commercial property and casualty background. And any claim would generally make your policy go up in price. Now, if it's something that's in the normal course, so let's say it's a hail claim. I live in Oklahoma. Hail is a problem. It just is. Well, look, if you have a hail claim that's been 2 years older, when I rate them up online, I'm not seeing any increase because that's not something that was avoidable. But if you have recurring avoidable claims, that's where you're going to run into problems.
Interesting. Do you guys do coverage on primary residences or only investment?
Non-owner occupied locations only. So if you're living there, I can't do that one.
Okay. Is a master policy different from a commercial umbrella policy? If so, do you offer commercial umbrella policies?
Okay, so this kind of goes back to the before. The master policy is just a way of managing a portfolio, of keeping them all on a master policy. And because that's how we manage the back end, it really has no relevance to the insured on the front. The commercial umbrella is a little bit, that's a totally different animal. So the answer is no, they're not the same. And I'm going to revert back to what we talked about before, is we would want to talk to you about your strategy, your acquisition strategy, where you're investing, what types of locations you're investing in, what your exit strategy looks like. And then we're going to talk about whether an umbrella is going to be the most relevant for what you need, or maybe excess liability. So no, they are not the same, and we just have to take that on a case by case.
Okay. John says, I have a California condo townhome, people on each side, but not below or above, and I have never had insurance on it. I own it free and clear. Do you insure such a thing?
Yes, we absolutely. So townhomes are single family. As long as there's not more than 20 in a row, we call them row homes. And there is a shared wall on either side with different occupants on the other, obviously. But yes, we can do that. That's not going to be a
Okay.
problem.
This next question here is, do you require 4-point inspections to initiate coverage? Does this make a difference in premiums?
No. And so let me brag a little bit about something that makes us different. So when we go through the process and we're taking the information and we're getting the rate and we're formulating the proposal, our system makes calls, electronic calls out to other data providers. And so we're going to pull information on that location, and every one of our carriers, because we've been doing it so long and our outcomes are really good, because our loss ratios are not that bad, they accept that in lieu of any inspection report or any kind of upfront that we're going to ask you for. And there is no post-bind inspection. So we're not going to ding dong you with that kind of stuff. It's automatically pulled. You're not going to have to worry about it.
So I was surprised to see that new optional coverage, the sewer line coverage. Is that an exception? Do they require, like, you guys want to see those lines first before we add on that coverage?
So there is some stipulation there for age of sewer. So if it's 50 years or older, I'm not necessarily going to say that's the coverage you're going to go to, because it does cut the payout benefit like down to $2,500. And so that is something to take into consideration.
Okay, that's good to know, because that's when you would want it, right?
Right. Well, I mean, but here's something else to think about. It's not just sewer; it's sewer, electric. On my personal property, I built a big shop in the back because I do woodwork and metalwork and stuff, and I built a man cave, which is now my office. And so I go out there and I work, and I've had 2 incidents where we have a brownout and we don't know what's going on. We have these things called gophers in Oklahoma, and they're not horse size like you think they would be, but it chewed through one leg of my electric line because we didn't put it in conduit. And so I'm like, okay, I'm smart enough. We're going to swap that for neutral, and we're off to the races again. 2 months later, the other hot leg got chewed through, and I know it killed the gophers, but still, it's a really nasty thing to do. And my cost on that, one of my best friends is the electrician, so I just paid the cost of the materials, but it was still significant. And so if you have something like that happen, it's not just sewer. Keep in mind, it's data, it's gas, it's electric, whatever.
Okay, I see. Okay, Karen, I'm really glad you snuck this question in at the last minute, because this came up for me this week and I should have asked it. The question is about insuring entities. Karen's specific question is, if I have a Wyoming LLC holding company, it doesn't hold any properties, do I need any kind of insurance for the Wyoming LLC? It only holds the state LLCs that she then has properties in.
Okay, so, and this is more of a general question. If you don't have assets under the LLC, you don't really have any exposure. And so if you're not operating any, if it's just a blank LLC that's a holding company, because I have a couple myself, there's no exposure to insure there. But once you do have operations under that LLC, you absolutely need insurance for that. But that brings me to another topic, and I know I keep piggybacking on these, but I'm sorry. We do multiple entities. So let's say you've got 5 different LLCs because you've got 5 different partners. We can still put all that on one schedule and give you one billing cycle, monthly billing cycle. Now, the only time that you may not want that is that if you have to fund those out of different bank accounts, then we'll set you up with an individual account for each one. But we can consolidate that, and the certificates of EOI reflect that. So it's a seamless process.
Yeah, I think this is one of the benefits of working with Inrig is you guys specialize in like working with investors and investor policies. So some of these questions about like entities and kind of how to optimize some of this very niche stuff, I think of just any other insurance broker, it might not be really their specialty in really knowing how to streamline that. So if you're having trouble, the client that wrote me, if I'm recalling right earlier this week, was having an issue finding insurance that would cover their entity.
Right. So we get a lot of clients that come over to us because let's say they own it as a sole proprietor. Well, they can get insurance for all day, but certain carriers won't do the commercial interest if you have an LLC. And so that's a common thing that we hear across the board. What I will tell you is if you're a sole proprietor, an LLC, an incorporated business, or a trust even, we can insure all of those entities.
Great. Okay, we'll end on this last one here because we're over the hour. David says, I've had a problem in the past of some carriers not wanting to insure homes owned by my IRA. Is that a problem with your carriers?
No, we do IRAs as well. I'm glad you brought this up because I forgot to mention that a second ago. Yes, we do within the IRA as well.
Great. Excellent. Well, Seth, again, this is a new partner of ours, guys. We brought them on because they're awesome at what they do. We've added them to our resource page. So if you're logged in to the Realty portal, you can hover over resources under insurance. You'll see Inrig listed there. Click it. You'll find the email address or the phone number to get connected with them. You can always request a quote there by visiting that URL, inrig.com/RWN for RealWealth Network. Seth, I'll let you kind of end it here and maybe give our viewers some final thoughts.
So, first off, I want to thank you for having us. We definitely have value in relationships with organizations like yours. But the one thing that I do want to impart to you is, and I used to be Bob on the corner, the insurance guy, but when it comes down to your investments, every investor has a different strategy because it's different locations, different types. What you're trying to achieve may be different than the 1,000 others that are doing it. What we're going to do is we're going to talk you through that because we want to provide a customized approach. It is not a good scenario where it's here's what I have and they have one option. We're going to give you a lot of options that others don't because we understand that within the insurance investing space, there's a lot of different variables that we need to take into consideration. Whereas the standard Bob on the corner, he's just not suited for that. So even if you do have something that's really weird, kind of wacky, you don't know what to do with it, give us a call because chances are we've heard it before and we could probably insure it.
Yeah, excellent. All right, Seth, I'm most appreciative for your time today. Thanks so much for joining us, and thanks everybody for joining us live. We definitely will get this replay up on the portal. We'll put it on the Inrig page where you find their contact information. So if you want to watch this again or you had to join late, we'll get that replay up there for you. Thanks, Seth. Have a great afternoon. Thanks for joining us.
Thank you.